Good evening, everybody. Thanks for hopping on. This is a first of our series that we're doing, where we are bringing on a first-time home buyer couple that is going through the process of buying a first-time home, and they have some questions. So we brought on the expert that we know, Kyle Lehman from Wintrust Mortgage, wearing his Hawkeye stuff, so we'll allow it. That's right. So what we're going to do is we're going to go ahead and I'll jump out of here, and we're just going to do some questions and answers. I'm sure that Caitlyn and Walker have questions about the process. Kyle's got some new programs and stuff out there that we want to talk about, and then if you, the listeners or viewers, have any questions, go ahead and comment on the streams, and we'll bring those into those guys as well. So with that, I'm going to change our background, and I'm going to remove real quick.
Hi, Kyle.
Hey guys, how are you?
Hi, I haven't gotten to introduce myself. I'm Caitlyn.
I'm Walker. Hello.
And I'm obviously Kyle. Yeah, good to meet you guys.
Yeah. So I'm a teacher first thing, so I write everything down. I have all my questions, so
Sure.
I can hit you with this first question if that's all right.
Yeah, go for it.
Yeah, so I think the biggest one, and I see it a lot with my friends and our friends and family, the benefit of owning versus renting, and vice versa. Like, what's the benefit of maybe renting versus owning, and when's the right time?
Yeah, that's a question that we get posed a lot. A lot of people want to know, why would I buy a house, right? Why can't I just rent? I'm not responsible for anything in my apartment. If something happens with the roof, or something happens with the siding, or the toilet floods, well, we don't have to worry about any of that stuff. We just call somebody, they come fix it, and that's just a built-in part of what we're paying for in our rental agreement, right?
Absolutely.
So yeah, there's most definitely some upside to renting. What I talk to people about is just creating wealth for yourself, right? So creating wealth for yourself now, creating wealth for your family down the road. The term generational wealth gets thrown around a lot, because buying a home is a massive purchase, but it's also more than likely going to be your biggest asset as you go through life. So buying that first home is always going to be scary. But to me, the perks of buying a house versus renting are you're far better owning a home than you are renting, if you can afford the upkeep and the maintenance, right? I mean, being realistic, if you have a toilet flood in your house, you're going to have to call a plumber. You're going to have to do those types of things and pay for it out of your own pocket. Or if one of you are very handy, or whoever's living in the house is handy, they can take care of things. And I can tell you that I wasn't necessarily the most handy person in the entire world, but we bought our first house, my wife and I did, 17 years ago, and I've done many repairs on my own in those 17 years, because you just learn how to do things. You learn how to fix things when they break, and that's a good part of being a homeowner too, right?
Yeah.
So yeah, I think that the biggest perk of being a homeowner is you're creating wealth for yourself. You're growing, your equity's growing as time goes on, and you're paying down the mortgage as time goes on. And so you're creating something that's lasting by doing something that you're already doing right now, and that's paying a housing expense.
Okay.
And
yeah, what else you guys have?
I agree with that, but with the way social media is set up nowadays, it almost makes you contemplate buying a home versus renting, because of, say, a landlord would be able to, or be liable to, pay for those expenses out of their pocket instead of.
So I think what you're saying, though, it comes down to is like when you feel financially ready to be able to take on those maintenance aspects, as well as what you might be paying for in a mortgage.
Correct. So we'll dive deep into this a little bit here. So you'll have an inspection done when you purchase a home. And it's probably about a $500 expense, anywhere from $300 to $500. And what that inspector is going to do is give you anywhere from a 40 to 60 page report that tells you everything that might be or is wrong with the home. So it's different than an appraisal. An appraiser is going to come in, they're going to look at your square footage, they're going to tell you the value of your home. An inspector is going to look at the electric box, they're going to figure out when the furnace was made and installed, the water heater, they're going to get up on the roof, they're going to go in the attic, they're going to look at the foundation of your home. They're going to do all of those things. So you can take a look at that inspection list. And if you have a good inspector, it's very detailed, and they'll tell you what will need to be fixed, what is a safety concern, or what is, something that's a 5 or 10 year away type of situation.
Right.
So
necessities versus
exactly
necessities.
Yep. So a lot of first time home buyers, we try to figure out a solution for them to get into a home with little to no money. Because if you can do that and you already have some savings, $3,000 or $4,000, let's say, for $3,000 or $4,000, you can fix most problems in your home, other than a roof and a furnace and air conditioner. You can get close on a furnace and AC, and there's some other things, right? Big ticket items, siding, those types of things. But for the most part, things that are going to pop up for the typical homeowner, that $3,000 to $4,000 is going to solve most of those problems. And a lot of the problems that you will encounter as a homeowner, insurance will resolve for you. Wind and hail damage. If you have a backup in your septic or your sewer or something along those lines, if you have that type of coverage, that will help too. But to your point, I think Walker, right? That was your first name. Sorry. Yeah. To your point. Yeah. You have necessities, and then you have things that, you don't necessarily have to take care of, but it's good to have that list and know what you're walking into.
Right.
Yeah.
Expenses versus non-expenses, I'd say.
Yep. And there's a lot of first-time home buyers right now that are actually buying townhomes that are brand new, which I believe is a good investment, A, and B, it's a good way to get into a home and not have to worry about a lot of the big ticket things. And most of the time you don't have to mow or, shovel your own driveway because you have HOA dues. So that's kind of nice too.
Yeah.
But a townhome or a condo is a really good way to get into a place without having the fear of the big ticket things going sideways if you're buying new.
Yeah, so it's kind of like a baby step into owning a house.
Yeah.
Okay.
Good way to put it. Yep.
Okay.
And by all means, I feel as if me and Kate are always looking at these options because we are generally interested, and we're thankful that you are here to talk to about this because you have way more knowledge than us. So,
right. And I think a big problem we see too is the spreading of misinformation on social media. So especially for people our age, it's kind of hard to know, okay, well, my dad and my parents and aunts and uncles might say one thing, but then other people
all these flooded mixed feelings coming towards you from both sources. But
yeah, so it's really
know
nice.
That you are in the position you are in for a reason, and that's why we're talking to you today.
Yeah, and I appreciate that. I think to your point, it's with anything, right? You can find the answer that you want to any question if you go on the internet.
Absolutely. Yeah.
Whatever answer that you want to find, you can find, whether it's right or wrong, right?
Right.
Some people will say you need 20% down to buy a house. You shouldn't do it. Some people will say only do a 15-year loan. Some people will say you should pay cash for a house, right? Everybody has a different opinion. I wouldn't say any of those opinions are wrong. It just depends on the person. I believe that people should do a 30-year mortgage, and if you can make payments ahead, then that's the way to do it. Unless you're a little bit further down along in life and have your career established and really things figured out, that 15-year loan is such a bigger payment than the 30. you can always pay ahead on the 30-year loan. But if you do a 15-year mortgage with a much larger payment, that's the payment that you have to make. There's no way around that, right?
There's no deadline, there's cut line.
Yeah.
Right.
Yep.
Yeah. So I think that leads perfectly into my next thing, which is, I think, debt. Like, that is such a scary word, and there's a lot of stigma around that. So would I be in debt for long? And you kind of answered that with saying, if we take a 30-year mortgage, then we would be able to pay ahead on that and not necessarily be in the debt for 30 years. But my question is, and I've never known the answer to this, if I don't have my mortgage paid off and we're ready to move to a different home, or like, how does that transfer over? I know that seems kind of thinking far ahead, but I think that's something, I'm such a far thinker, just something always in the back.
Well, let's cover the first thing first. So let's talk about debt. There's a lot of people don't ever think as debt as good. There is good debt and there's bad debt. The good debt is the debt that is going to help me, right? And that debt is what debt can create more money for me down the road, right? So if I'm buying a house, that isn't necessarily bad debt. You're creating equity, you're building, you're not paying somebody else for your home or to live somewhere. So a lot of people look at that
finances,
good debt, right?
Mm-hmm.
Bad debt are when you go buy things that you maybe necessarily shouldn't or can't afford, and then you put them on a credit card, or you buy a car that's $50,000 and you make $50,000 in a year. That's, to me, is bad debt. We see it all the time, though. People would absolutely qualify to go buy a home, but they have a $700 or an $800 a month car payment, and they make, they make $4,000 to $5,000 a month, and that's before taxes. That's gross, and so that's $800 a month car payment eliminates them from being able to buy a home. And
my parents have always said, like, there are some people that would rather have a fancy car versus a nice home.
Yeah.
And I understand what you're saying from that perspective, where you can either have a house or a nice car, which you can't drive a car. You can't drive a house versus driving a car.
Mm-hmm.
So I understand what you say.
The thing is you can do both, right? You have to, we're in a generation right now that everybody wants everything right now.
Right.
Social media has made it that way, right? You can get information so quickly, so we just expect everything else to happen so fast. And so it's like, oh, the car dealership said I could buy this car. But the car dealership doesn't do the extensive deep dive that a mortgage company would, right? To see if you can really afford something. They're just saying, hey, if we can get you the loan, then you're good. And that's nothing against car dealerships, right? We're the ones that sign up. We're the ones that put the pen to the paper and say, yeah, I'll take the $800 a month payment. But yeah, debt will get less scary as time goes on. There's absolutely a good debt and a bad debt. I would never classify real estate personally as bad debt. I just don't see it that way. Houses go up in value. You're paying down on them, so you're gaining equity with it. And I'm sorry, what was your second question, Caitlyn?
I'm going into that, like, down the line,
when
we're ready to move into a different house.
Yep. So that's pretty straightforward, actually. You would, find a realtor, and we can connect you with a realtor. We work with multiple realtors on a daily basis. And then what would happen is you would put your home for sale, and then you would use the equity that you've built up in that. Let's say you sell your house for $200,000 and you owe $170, and after realtor fees and costs, let's say you get $20,000, right? Then you could use that $20,000 to buy your new home. Typically what folks do is they'll do a same day closing. So you guys would close on your current home on Friday morning. They would have that check, and that check would be at the law office or the attorney's office for you when you go to sign the new documents for your brand new home. And that's what you would use for your new down payment.
Okay.
I think that's where you're going with that, right?
Yeah.
Yeah.
Mhm.
Okay. Yep.
And then the loan on that would, so if I haven't finished that, oh, I understand. Never mind. I understand what you're saying.
You're good. People ask all
Because
the time.
I'm selling, because the house, I'm selling it for 200,000. If my loan was 470 or whatever, then it would, I understand.
Yeah, when you it's just like when you go trade a car in, right? Except
Absolutely.
when you go trade a car in, you're always upside down, it seems like most of the time. But when you
Right.
trade a car in, if it's paid off, they take that money and apply it towards your new loan, or they pay off your old loan, I should say. And that's what would happen in this instance. Your old loan would get paid off, and then the new loan would just start brand new, whatever terms you decided to do.
Okay.
I just wanted to jump in here. Kyle, you were talking about good debt. There's also some benefits to that as well. Tax write-off. So you get a tax write-off with the interest that you pay and things like that. Why don't you maybe explain a little bit about that to them and what the benefits of that are as well?
Yes.
Honestly, I appreciate you saying that, Chris, because I have no knowledge throughout that, like knowing about that, because, you know, I wasn't taught it in school, and
Taxes, loans. Yeah.
that's one thing I appreciate him saying, and because I'm not very knowledgeable on that.
So yeah, taxes, there used to be, and Chris can probably back this up, there used to be a much bigger benefit from a tax perspective. But when they raised the standardized deduction limit up a couple of years ago, a lot of those benefits, I wouldn't say went away, but they may not be as beneficial as they once were. So from a tax benefit, there can be. Now, when you first buy your home, you'll have some things that you can typically write off on taxes, you know, your closing costs, expenses, things along those lines. And that's obviously helpful. From an interest perspective and property tax, it just depends on how much that is and what other deductions you have. You stay below the standardized deduction limit, or you go over it.
Did not know that.
Yeah, so it could be either way. It's not going to be a massive help, but it can be a bit of a help to you. Now, deep dive, right? I mean, people that have rental properties and second homes and stuff like that, that's when you can really get into some, you know, pretty significant tax benefits, but we'll table that for a different time.
Yeah.
Right. And that's something personally like that I would like to go over, because talking about it more with Caitlyn, something I'd like to create that generational wealth for our family once, you know.
Yeah. Yeah, I agree. Oh, I had a really good question and now I just forgot it. I know that something when my parents moved into their new home when I was in high school, they had something called a home warranty, which kind of helped them if things broke down, kind of help pay off. Do you recommend new home buyers to get that home warranty to help pay help with some of those expenses that might come up?
Yeah, typically you can get the seller to pay for it. Your realtor will work all of that out for you, but typically the seller expects to pay for something like that. The nice thing with home warranties, and you'll want to do research on them. You want to talk to your realtor, and I can go through those with you as well. But typically your realtor will have someone that they've worked with and they've had good success with. And the nice thing with them is when it's renewal time or after that first year, they're going to send you an email or call you, you know, at that 10-month mark and say, hey, do you guys want to renew this? And typically you'll just pay the same $495, $695, whatever that dollar amount is, and you'll renew it for a full year. So let's say if you buy a home and the furnace is, you know, 20 years old, and you get a home warranty the first year and the furnace, you know, keeps on going, more than likely, if you buy a couple more years of home warranty, that furnace is probably going to give in, and you'll end up paying, the deductible, and they'll replace the furnace if that's part of your home warranty. So
Okay.
that's one of those things to think.
Like an insurance kind of deal right there, would you say?
Similar to, yeah, it's typically
Like a full coverage on a house, would you say?
cover appliances, water heater, AC, furnace. That's the big stuff that it's going to cover for you.
Okay.
So, yep.
Yeah.
Good question though. What else you guys have?
Oh.
I can hop in with a question that we got online. Was there was some conversation today on Twitter about to now not being a good time to buying a house. They want to move and buy a house, but because of interest rates and so on, they feel like maybe it's not the best time. So what is your response to that? Because I know that interest rates are higher than they were, say, 2 years ago when Stacy and I refinanced through you, but they're still coming down a little bit. And I think maybe it's a good idea to I think there's a little bit of fear out there of people doing now because they're afraid this isn't the best time to finance.
So the first thing I'll say is that we've all been conditioned over the last decade that we should all be able to get a mortgage for, 2, 3, 4% interest with no issues. In reality, before, the financial crisis in 2008, a typical mortgage rate is what we have today. Anywhere from, let's say, 5.25% to 6.5%. That's what people paid for a mortgage. That's a healthy mortgage market, is to be between 5 and 7%. Realistically, probably like 6 to 7%. That's a healthy mortgage market. Now, do I think that people should stop buying homes right now because the rates are high? I mean, my obvious answer is no, because if people stop doing that, then I'm not going to have a job, right?
Right.
But I'll back that answer up with this. Rates are high right now. A lot of people that you talk to are saying, well, I'm going to wait until the rates go down. How many other people are waiting until the rates go down?
So
right?
I bet.
A lot, right? So let's say that there's 100 people. 10 of those people go out and buy a house in the next month, and they all spend $200,000 a piece, right? And they pay 6% for their mortgage. Those other 90 people, they wait, and then in 3 months from now, rates drop to 4.5%. Well, what do you think is going to happen when rates drop to 4.5% and those 90 people go look at houses?
Is what's going to happen? Isn't this kind of what happened? Just like last year, 2 years ago, where like everyone was trying to buy a house, and so house prices kept going up. And
then, exactly. So the market's going to get flooded, right? Instead of 5 or 10 people maybe walking through your house over a month span, those 90 people are now chomping at the bit. They've been wanting to buy for a year. They're waiting for rates to go down. They're going to go look at a house that's priced at $225 that the neighbor just bought for $200,000, right? Let's say 9 months ago, whatever. And that $225 is going to become $240, and because they're in a bidding war, right? And then they're going to have to go look at the next house, and that's what it's going to be. That's, if rates come down, that's what's going to happen.
Where it'd be
it's just a war. What's that?
Where it would just be a constant back and forth bidding war on pretty much every house or property you see, would you say?
Yeah. I mean, it's going to get back to where it was, 6 or 9, 12 months ago. Like 15 months ago, really.
I feel as if we are in a good time to start looking at these opportunities because of the information you are giving us, like, is very useful. Me and Caitlyn don't know much about this at all.
Sure. And to add on to the other piece too, is that if there's not a lot of buyers, the sellers are going to be willing to do more. If you are a buyer, they're going to be willing to do, give you closing costs. Last winter, end of 21, beginning of 22, you were insane. It seemed like if you asked the seller to provide closing costs. Now it's a given. Like it's everybody basically that asks for it and gets it with really no issues. Anything under, 200,000 right now, 225 is a little bit different, because that's the bucket that a lot of people are buying in.
Yeah.
Now, that doesn't mean that it's bad to buy in that range. It might just take a little bit longer. But Chris, to your question in reference to what somebody had asked, if I'm buying, I'm going to buy before rates go down, because what can I do if I buy a house for 200,000 and my rate's 6% and then rates go down to 4.5%? You can refinance, and guess
Right.
what? You're only going to owe 200,000 minus whatever you put for a down payment. Instead of the rates go down, you pay 225. Your payment's going to be probably the same, maybe a little bit less on the 225, but your neighbor's still going to owe $25,000 less than you, and they're going to have the same rate as you because they're just going to refi. So it just doesn't make a whole lot of sense to me to wait if you're waiting for the rate to go down.
That's a great point. That hadn't dawned on me as you were talking. I was thinking, to Caitlyn's point, a year and a half ago was probably more of a seller's market. You weren't able to get a lot of concessions, and you were probably going to overpay for a house a little bit, as opposed to now where it's a buyer's market. You might be able to get more house for the price, possibly, and some concessions. And to your point, if rates do go down in a year and a half or whatever, you still have that option to refinance and then recoup that.
Yeah.
So about refinancing, is there like a certain amount of time that you have to be under your mortgage to refinance, or are you able to refinance at any time?
Typically 6 months is about the time frame. And a lot of people, the question that they ask is, well, how much does my rate need to go down? There's a lot of disagreement with this. I don't think that there's a good answer. My answer is always, what's the break even point, right? If you're going to spend $2,500 to refinance, how fast can you get your money back? And if you can get your money back by dropping your rate a half a point in 2 years, then refinance. If you can get it back in 3 years, then refi. I think anything after 3, you probably need to really consider, what you're doing and really make sure that you're going to be in the house long term. But some people you can find on the internet, a lot of people say you've got to drop at least a full point. I don't believe that at all. When you put pen to paper and when you look at the numbers, that's really what matters. For some people, it takes a full point for it to make sense. For some people, it's a half a point. But that's all. It's just person to person. There's no simple answer for that.
And I feel as if I'm going through this right now with my vehicle as well. So, I understand what you're saying, but it's kind of that median where this is just a new playing field. So,
yeah.
So one other question that came in was for first-time home buyers. I mean, the allure is to want to go out and look at houses and things like that. But is it better to get pre-approved, or is it better to find what you're looking for and then go to go to a mortgage person? Pre-approval is the way to go, right? Because that kind of gives you a frame of where to go and how difficult is that to go through. So
you should always get pre-approved before you go look at a house. I don't care what the scenario is. If you go,
just making sure our credit's in line. So
there's a bunch of different reasons. A lot of people will go look at a house that's 300,000 and they fall in love with it and they're like, I've got to have this place. It meets all my criteria. And then they submit the app and they're approved for 225,000, right? And then all of a sudden you're the bad guy. I'm the bad guy having to deliver that news to them because they found this amazing house. But if they have that information going into it, you're working off of factual information, you're not making assumptions, right? That you can do something that you might not be able to. The other piece is that, especially first-time buyers, we want to talk to them, walk them through what the process looks like, make sure they have a realtor that's helping them, make sure that the realtor has them set up with the proper searches. We want to get in contact with the realtor and explain to them exactly, what the pre-approval means, how we pre-approve them, how strong the pre-approval is. We want to build that relationship, with all three of those, people, to make sure that everybody is on the same page. So it creates a seamless process. The other thing the pre-approval will allow you to do is, if you have a pre-approval and somebody else doesn't, or if you have a pre-approval that says that you've been fully qualified, that makes you a much stronger candidate. And if we have that relationship with your realtor and with the customer, typically we'll call whoever's selling the house and explain to them how strong the approval is. And then, Chris, your other question, how long does it take? We have an online application. It's fairly simple. I believe that it's the same one that you guys did a couple of years ago.
Right. Chris was telling us about this process, and he told us it was very easy. And
you're looking at maybe like a 20-minute process on the application if you have your information. Let's call it a half an hour. And then typically, depending on the day, we can get a pre-approval, turned around in about an hour from the time we actually get the application. On the weekends, it might take a little bit longer, say 4 or 5 hours, depending. But there's, 5 people on my team, and between the 5 of us, somebody can jump in there and typically grab it and get the pre-approval out to the customer and the realtor.
Got a comment here from a listener, Kenzie Aldrich, wanting to know, I'm going to pop it up there on the screen, what is a good down payment for somebody?
I would just say that it depends on the scenario. So if you do FHA, they just require minimum 3% down. Conventional, if you're a first-time buyer, you can do 3% of the purchase price. So your down payment is going to dictate a few things. It's going to dictate what your payment is, and your payment is then going to dictate how much you can get approved for. The other piece with the down payment is it's also going to impact if you have to pay what's called private mortgage insurance. And that's something that we haven't talked about, that really, I would say most first-time home buyers are going to run into because they're not able to put 20% down. So if you have private mortgage insurance, the more you put down before you hit 20%, the less that payment's going to be for the PMI, and the sooner you can get it removed. So for me, it really just depends on the situation. We do have down payment assistance programs to people that qualify. We have a $10,000 forgivable grant, a $5,000 bond, and a $2,500 forgivable grant. And then we also have a $5,000 military homeowner assistance program that doesn't have any income qualifications. You just had to have been active duty for the last for 90 days prior to or after 9/11 or during the Gulf War, 91 to 93, somewhere in that ballpark. So Iowa Finance Authority is who has those programs, and then the $10,000 grant that I mentioned is through the First Home Loan Bank of Chicago.
Yeah, I was going to ask you about those programs. So, and I'm kind of jumping in here because as a father, no, as a dad, now I want to ask these questions to try to help the kids and whatever. But, Caitlyn just has a brand new job. Walker's in one of his first jobs and so on. Talk about a little bit about the process of getting approved as a first-time home buyer. They don't have a lot of credit built up. It's not like they have a credit score that say is going to be immaculate because they've built up a lot of credit. So how does that work for them and things like that?
Here, actually,
he has to brag on his credit score.
I have a really good credit.
All right. Well, other people other than Walker.
Well, I think that just goes back to, I actually just talked to a guy this morning that was wanting to do a pre-approval and he was unsure on his credit score. And what I tell people is just do the application, because we don't know what we don't know, right? A lot of people talk about Credit Karma or my my Wells Fargo app says this, or my Chase app says this, or whatever app you have that you're looking at your credit score. And those are all great. That's going to give you a ballpark of what it is. But at the end of the day, again, it's best to work off of factual information.
Yeah.
And let's say we pull credit for someone and there's somebody that has a credit score that doesn't qualify. We can go to the credit bureaus and we essentially run different scenarios. What if Jane Doe paid off her credit card? What if they paid it down to $200 instead of it being at 500? And it will tell us what their score would adjust to if they do those things. So we get a lot of people from other realtors that get denied somewhere. And, some people, they don't have that program. They don't have access to it, and they get denied and they come to us just so we can pull their credit and figure out if we can have a solution, figure out if we can find a solution for them to get their credit score up. Those first-time homebuyer programs, IFA, Iowa Finance Authority, requires a 640 credit score or above for both customers or whoever's on the loan application. The other $10,000 grant, the minimum score would be a 620 because that's what we require. There are places that will go to 580 for FHA, but you have to have a lot of assets in order to do that. You have to have a really strong file other than your credit score. So hopefully that answers those questions for you, Chris.
Yeah. Caitlyn, do you have anything else?
No, I guess as somebody who doesn't have much of a credit score, well, that could have changed since when I moved into my apartment in August. My only option was the highest deposit because I didn't have much of a credit score.
Mm-hmm.
But now I've been paying my rent on time.
And that's building credit, though.
And I've been paying off this personal loan that I have from school. So is that helping me build that credit up? I mean, I obviously don't know the exact score or anything, but are those things without having a credit card, or is a credit card something that can be good when used in the right way?
No, that's a good question. So your rent, this is something that a lot of people do not know. Your rent does not report to your credit unless you report it to your credit on your own, or you're renting from a place that will report it to your credit. The other piece is a lot of places, apartment complexes that may report your credit will only report it to one credit bureau because it costs money for them to report it. So that is one thing. If I were you, I would ask your apartment complex wherever it is that you're living and say, hey, do you guys report to credit my on-time payments? If they don't, I would suggest to you to go to the 3 credit bureaus, TransUnion, Equifax, and Experian, and ask them if you can get your credit or get your rent to start reporting on your credit. I don't know if all 3 have it. I know for sure that Experian does have self-reported credit. And it's a little bit of work. I think it's like $30 a month, $40 a month that you'd have to pay for it. But if you don't have much else on there, then you don't really have an option, right? If you have a personal loan that you're paying, that's fantastic. I wouldn't do anything with that in terms of going and getting a credit card or anything along those lines until you have your credit pulled by somebody and you get your actual scores.
I feel as if, my credit score got pulled because recently I bought a newer used vehicle and my credit score got pulled. I don't know if that's something I'll have to reach out about, to my apartment complex and ask them, if they do submit it, because I feel as if I'm building my credit throughout my homeowner experience through renting different apartments over the time.
Yeah.
Yeah. And some, like I said, some do and some don't. And that is always kind of a mind-blowing thing for first-time people, especially if you're renting from, someone like if you're renting just from me, right? Just a not a landlord, not necessarily an apartment complex. A lot of those places don't report to your credit. So it's something that I would absolutely recommend, but I won't ever give a suggestion to anybody in terms of, hey, go get a credit card or something like that.
Right.
Would you say
unless-
credit is being able to be built throughout paying like a phone bill, say just paying different bills that
Yeah,
we
I
as
guess
simple adults, I should say, are just building credit throughout like maybe a phone bill, internet.
yeah,
so on and
what
so
are
forth.
like the things that help build your credit, I think.
Yeah, no, oddly enough, and this is a huge pet peeve of mine, is it's the things that make you go into debt. Which makes
Like
no
what
sense to
you
me,
say.
right? So like to Walker's point, if you have a Verizon phone bill and you've paid that thing for 3 years on time and you've paid your utilities for 3 years on time, you can self-report that stuff. Like we were just talking about, but it doesn't automatically populate on there.
Okay.
So getting a credit card is not a bad idea. Anybody that I do talk to about that, I always tell them do a secured credit card, which is typically $300 to $500 is what you can get. And what they do on secured cards is they will take that $300 to $500 from you. You'll have to put it into a savings account with them or some sort of, checking, and you cannot access that money unless you close the card or until they feel like you've made ample on-time payments to them, and then they'll release that money back to you. So essentially you're borrowing that money against that savings account.
Mm-hmm.
And if you happen to, rack it up to the limit of $500, let's say, and then you just decide, hey, we're not paying this anymore, they'll just take the money out of your savings account that they've forced you to have with them and pay that card off for you, which is not a good thing. But
Right. No,
but having a secured card is not bad. I just wouldn't suggest it until you know exactly where you stand with your credit scores.
okay. No, that's really good to know, because I know some people who don't have a credit card,
and I'm an example. I don't have a credit card personally because I was taught at a young age that it is not a necessity and not one of those things we need,
Yeah.
And I feel as if me personally, I feel I've come a long way without one. So
yeah, I don't think that
or credit card is not the way to go, because I think
Right.
that's how a lot of people get into debt pretty fast.
I don't know, those Bass Pro cards look pretty
it's all about self-control, right?
Yeah.
And you have to know yourself. If you know that if you go get a credit card, you're going to overspend on it and spend money that you don't have, then you shouldn't get one. Right? I mean, that's just what it is. And
Absolutely.
if you know that you're just going to use it for stuff that you can easily pay off and pay it off every single month, then yeah, I think they're perfectly fine. But everybody has to make that decision for themselves. But it
I have a lot of
is a
friends
good way
that
to
use
build
them for
credit.
gas cards.
Yeah, like a gas card.
Yep.
Mhm.
And that's again, as long that I think ties right into the secured credit card.
Yeah.
If you're using it for stuff that you're already going to buy and you're immediately paying it off within, a couple of weeks, then yeah, it's not terrible by any means.
Right. Yeah. I mean,
Awesome. Good stuff. Well, I think we're probably, Caitlyn, right? You didn't have anything else. Is that right?
No, but I got lots of good information, lots to talk about and think about when going into this process.
So going into the process, Kyle, somebody wants to contact you and wants to get a pre-approval and stuff.
Yeah.
What's the best way to get a hold of you? We got your phone number here, but what's the best way to get a hold of you and get started on the process?
Yeah, that's the best. That number up there, the 515-473-0546, that's my cell. People can text or call me on that. And if somebody wants to get started, they can text me a good time to call them or text me and send me their email. And I'm happy to send information that way. Whatever's simplest. But yeah, that's going to be the easiest route to get a hold of me.
Yeah.
Awesome. All right. Well, I think this has been really helpful. It's been really good stuff. Great information. and want to thank everybody for hopping on and listening. Thank you, Kyle, for the continued support of our podcast and our mission here. So
thank you guys.
With that, we will end it with a little rock music and fade to black. Everybody have a great night.
See you guys. Thanks.
Bye. Thank you so much, Kyle.
Yep, you got it.